Good morning, everybody. Welcome to today's event. This is Andrew Wilkinson with Interactive Brokers, and I am joined today by Jose Torres, who's our senior economist, who's not in Florida. Where are you today, Jose? I don't recognize that background.
Yeah, I'm in Scottsdale, Arizona, so it's actually 6:15 a.m. here. I got here yesterday here for the IMN's Beneficial Owners Securities Finance Conference. I'll be doing the keynote economic speaking event today. And then one of our colleagues, Andrew from Interactive Brokers, William Pepe from the Securities Lending Division, he's going to be on a panel tomorrow, Friday, February 13th. So we're out here in Scottsdale doing some economic analysis. And of course, top of mind is yesterday's non-farm payrolls and tomorrow's consumer price index. Today's producer price index, which is the title of the stream, was delayed due to the partial government shutdown. So we're not going to be, unfortunately, talking about those numbers as they come out. However, we do have initial unemployment claims coming out at 8:30 a.m., which aren't as high impact, but we'll still talk about those.
Okay, so two inflation numbers. They are a factor in the Fed's decision making. But let's talk first about. So if inflation's under control, the Fed might ease policy. If unemployment is getting out of control, the Fed might ease policy. But let's talk about the January payroll number yesterday, Jose. I think 130,000 jobs added. The unemployment rate fell, which was more than expected. The unemployment rate fell to 4.3%. But within that 130,000 job additions, what did it look like?
So we had this non-cyclical tilt, Andrew. We had education and health services had the bulk of the jobs. I'm pulling up some graphics to share with you all shortly. The unemployment rate ticked down. It was the strongest number in around 2 years. We got the annual benchmark revisions for the 12-month period going to March of 2025, and that took off a heavy chunk of job gains. So, Andrew, really, from a hiring standpoint, a lot of sectors are flat. Some are down. Manufacturing is down in the last 12 months. And really, it's the non-cyclical education and health services area that's bolstering the numbers. Still, the report was strong enough to quell Fed easing expectations. Wall Street was approaching perhaps 3 rate cuts in 2026, but then after yesterday's payroll beat, expected only 70,000, so almost a double beat at 130,000. After that blockbuster number, folks said, okay, let's get back to around 2 cuts for 2026.
I'm not entirely convinced, Jose, that it was the right move to start pricing out rate cuts on account of the big add to healthcare. I read somewhere that healthcare job addition was greater for January than for the average in the fourth quarter of last year. So it just seems to be an outlier.
There's definitely there's mixed messages from the labor market. Of course, last week we got 4 labor market data points that were very weak. So Challenger Christmas and Gray reported the highest amount of job cut announcements for a January going back to 2009, 17 years. That's a great financial crisis. Hiring intentions also lowest since that same month. Then we got initial unemployment claims and continuing unemployment claims climbing. On their own wouldn't have been too disappointing, but because they occurred alongside the Challenger data, alongside the ADP data that badly missed expectations. And then also you had the JOLTS number, Andrew. The JOLTS number was the weakest going back to the pandemic. So you had really a litany of weaker than expected numbers last week. And there's a sense amongst market participants and economists that the non-farm payroll data's quality is not as strong as some of the other surveys. And now what we're doing, Andrew, me specifically, should talk for myself in this case, but I think my colleagues as well, we're starting to increasingly rely on the buffet of data and see what each distinct dish tells us rather than overly relying on one specific report, which, Andrew, you've been in the game for a long time. You're a veteran of Wall Street. You know that payrolls was everything for such a long time. Nowadays, it's more reduced. we're looking at a lot of other reports to really try and gauge the strength of the labor market.
So let me put, as you mentioned the revisions to last year's data, Jose. All said and done, when the revisions were fed through, the net job gain for 2025 was 181,000. And that compares to yesterday's number of 130,000. So the employment picture, according to this report, was actually quite weak. Would you agree? How would policymakers at the FOMC, at the Federal Reserve, how do you think that message will sit with them, that data?
The thing with that is that I think that because we don't necessarily see much stress in the labor market, I think because we're not seeing the layoffs and we're seeing a low unemployment rate, we're still seeing consumer spending is robust, productivity is robust. And Andrew, we're really challenged by these demographics. You know, we have an aging population. We don't have as many immigrants, so the labor supply is being weighed down by the immigration restriction. The labor demand, we have the demographics, the aging population. We have the AI starting to make its way into corporate America and start to perform tasks that would have otherwise have been taken care of by a new employee. And then we have rates that are still too high for some of the rate sensitive industries, namely manufacturing, construction, and small business. And here's a chart we were talking about for last month, Andrew. As you can see, really everything came from private education and health services, which added around 135,000 jobs or so. And you had really minuscule contributions from professional business services as well as construction. Now, Andrew, I think you're going to like this look here in terms of its perception, not actually, in terms of its perspective, not actually the message that it gives off. But here is the 12-month net change across sectors. And we actually see that in the last 12 months, Andrew, to your point, we're seeing that most sectors lost jobs in the last 12 months. You know, despite the non-cyclical large sector we've been talking about, education and health, a little bit in leisure and hospitality, a little bit in other services. But look at finances down. This is over 12 months, folks. This is not one report. Government's down, of course. Manufacturing is down. That's been a drag. Especially since the president and the White House has really been trying to bolster that sector. So, you know, these dynamics are a little worrisome, but wage pressures, wage pressures, Andrew, were a lot stronger in this report than expected, average hourly earnings. So there's still this bifurcation in the labor market where some people are doing well. They're getting pay raises. There's not that much competition amongst workers in the overall economy if you have a specific skill. And then you have folks like reflected in the consumer confidence surveys and in the sentiment surveys from UMich and Conference Board, respectively, that they're really having trouble finding work at all. And they're pretty pessimistic about labor opportunities.
So when you look at that, that's a fascinating chart you just showed. But if you overlay initial claims over that, I'm wondering how that looks. Can you get like a more granular feel for the labour market by considering what's happened with initial claims? If there's not that much job creation going through, which is what you just showed, or even layoffs, are we seeing an elevated reading of initial claims for last year?
Pulling that up now, but not really. Initial claims have been relatively controlled, and that plays into the hand of the Fed not necessarily having to respond to a weakening labor market. The fact is, from where policymakers stand today, essentially, if you want a job, generally speaking, you can find one. A lot of people just genuinely aren't as involved in the labor market. We'll look at labor force participation rate later to reflect just less of a need, a less labor intensive economy. Let me show you all initial claims here. Yeah, so we've had some spikes We got up to around 260,000 or so back in September, but we've been pretty controlled. The 220 area over a long horizon is particularly steady, and that's really where we are. This latest spike up to 231,000, that was up here. That was really what, not disappointing on its own, like I said earlier, but because you had the weak jolts, the weak ADP, and the weak Challenger, Gray, and Christmas, folks didn't like this jump. But let's take a look real quick at continuing claims, which essentially reflect those folks that are unemployed. How long is it essentially taking them to replace their jobs?
And that's basically been a little lower than it had throughout 2025. So that's kind of a real mixed message, is it not?
Yeah, here's a mixed message. Here you have folks that are essentially consistently unemployed since the beginning of 2023 or so. The number to watch here is 1.9 million. That's sort of or 2 million. That's sort of when we go north of that. We haven't really been north of that a lot. So that's a number. And when we go north of that, we got to start being careful. On initial claims, numbers above 250,000, 260,000 for a prolonged period, right? Not one or two reports, but over 2-3 months. If you start seeing that, then it's cause for concern. But it's the same bifurcation we're hearing on the earnings calls, folks. The lower income consumers, they're having more trouble finding work. They're having more trouble with affordability. The higher income consumers, they feel okay. They're happy with strong capital markets and with strong wages. So, this continuing claim statistics, this trajectory really tells me that at the bottom end, those folks are having trouble finding adequate work that they'd like to do.
What? Just real briefly on the initial and the continuing, what are your numbers for 830 supposed to be? And then we should talk about inflation before that comes out.
Sure.
And I would also remind the audience that there's a nice chat panel there if you want to put any questions in, particularly after the numbers for Jose, and we'll try and discuss those.
Yeah, so for initial claims, Andrew coming out in 1 minute and 39 seconds, expecting 222,000, a little bit of relief from the prior week's 231,000. And continuing claims, really similar story, a little bit of small increase from 1.844 million to 1.85 million on a week-to-week basis. So, relatively controlled. Inflation tomorrow, the expectation is 0.3% month-over-month gains on core and on headline. However, due to positive base effects that subdue the annualized figures, we're only expecting headline and core inflation to come in at 2.5%. And I think that there's room to do better than that. I think that there's a chance that we come in at 2.4. That would be music to.
Looks like there he is. He's back.
I'm back.
We lost you there for
sorry. Depending on hotel Wi-Fi here. So there is a chance that we come in at 2.4%, folks, on core CPI and headline CPI, and that would really be music to the ears of not just equity investors, but also fixed income investors, because 2.4, we know it's not the Fed's preferred gauge, it's the CPI, but once you start getting closer to 2, you're in the low 2s, now you could dish out an extra risk management cut or not. And that's really what equity market participants are looking for, especially with this year's leadership that has been concentrated in the cyclical areas like the Dow Jones Industrial and the Russell 2000, which have especially outperformed. Folks are a little bit tired of tech, it seems. There's been fading enthusiasm in that space for now, but what you need for that cyclical trade to keep going, folks, is you need rate cuts, because those areas stand to benefit disproportionately from monetary policy accommodation, especially the Russell 2000, which, by the way, folks, is already up 8% year to date. The NASDAQ 100 is down a little bit, and the S&P is up around 1%. Dow made it above 50,000 pretty resiliently, pretty ferociously, and stayed above that for a little bit. The S&P, however, only made it above 7,000 once, and it's still having trouble to get above that 7,000 threshold. It's relied on tech for a lot of its gains in the past. Now the cyclical areas are starting to push forward. And just shifting gears real quick, initial claims, 227,000 compared to 222,000. Those are numbers that ended last Saturday for that 7-day period. And then for the week before that, continuing claims increased to 1.862 million, despite expectations of 1.85 million. Not much of a reaction in the markets, of course. These are not necessarily the highest impact numbers. Futures are still up a little bit on the S&P, on the Qs, really across the board. On the Russell, especially up 72 bips. Yields are around their flat lines. The 10-year is down around 1 basis point to 4.16, which that's been, some progress considering that it was around 4.30 or so a few weeks ago. So I think actually, Andrew, the yield story is interesting because yesterday on the non-farm payrolls print, you saw yields pop initially because it was a strong number. I guess it takes people, they're not as, folks are not as impressive as us in reading the report that fast and realizing that under the hood of the report, really the numbers weren't as robust as the initial move in yields would have suggested. So in the yield story, as the day progressed, as folks started watching CNBC, listening to our analysis here on Interactive Brokers Live, folks start to realize, oh, these numbers aren't that robust, so let's bring yields down a little bit. So especially, definitely a lot of space to go down lower because CPI tomorrow, Andrew, if it's 2.4%, the 10-year at 4.16, do you really justify almost 200 basis points of spread on top of the CPI and the 10-year in this day and age? Probably not. Probably around 390, 380 is fair value there.
What does the event contract market, what does our forecast trader look like in terms of the CPI print for tomorrow?
Yeah, going to pull that up now. Let's go to Steve real quick.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy a yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
All right, we're back, folks. Just want to also talk to you a little bit about how our customers did last year, which has been talking point on our earnings calls and across the firm. We're really happy about how our customers did last year. Let's see if I could. Can you see that, Andrew?
Yes, we can.
Yes. So, folks, our customers, this is a testament to our low-cost business model and our focus on our clients. We offer, as I think most of you know, really low margin rates, really elevated rates on cash in accounts for customers, highest quality execution, a lot of global access in a one unified platform, as well as very fair commissions and the robust technology that our executives have worked on since the late 1970s resulted in a really robust 2025, not just for our client accounts, which grew above 4 million, and our revenues and earnings, which are at records, but when you consider how our hedge fund clients did relative to the S&P 500 index, folks, our hedge fund clients posted 28.9% average return. That's above 2,000 hedge funds that we have here. The S&P returned 17.9. Considering individual clients, 19.2%. S&P 500 did 17.5. So really, testament to how Interactive Brokers and how our platform and our technology enable our customers of different types: large hedge funds, small hedge funds, people on the street, sophisticated individual entrepreneurs, to really go out there and do well in the market. And just tilting back to the labor market here, folks, yesterday's number was 130,000. It was the strongest in roughly 2 years. As you can see, those revisions really knocked down a lot of these gains in early 2025, here from January to March, as well as the year before. Retail sales also has been robust, but December number we got earlier this week was a 0. So that was a little disappointing to see that consumption halted to a stall to end the year last year. That could be reflecting government shutdown uncertainties, consumer exhaustion, high prices, job uncertainties. Still the third quarter of 2025, fastest pace of growth since Q3 of 2023, so in 2 years. Just sharing some charts with you all, folks. Here's the numbers from ADP. However, the numbers from ADP reflected 7 consecutive months of hiring growth, albeit this is only the private sector, albeit it is slowing here down to roughly 22,000. Some of the previous job losses got revised away. Productivity has really come to the rescue amidst weaker hiring, helping the economy and earnings expand. Q3 of 2025, similar, strongest as GDP, strongest number in 2 years, going back to late 2023. Consumer confidence, we spoke about this earlier, down to a 12-year low, below the depths of the pandemic, folks. Down here at 84, we didn't make it but to 84 in April of 2020 or in August of 2020. We made it just above that. But that's a Conference Board's confidence index. But the Michigan Sentiment Index, still low, but jumped to a 6-month high in February. So really, mixed messaging there. In the Consumer Confidence Survey, we heard that folks were typical dinner table worries, prices, job availability, interest rates, that was really hurting them. But then in the University of Michigan survey, we heard that stock market gains were really making people happy. And that also that folks started to notice that the pace of inflation was starting to decelerate, and inflation expectations came in aggregate, led by short 1-year inflation expectations, even though the 5-year inflation expectations lifted by 0.1%, but it went down 50 basis points for the 1 year. So that helped push sentiment up to a 6-month high. Existing home sales, we'll get that later today, but December was a 34-month high on the back of 4 consecutive months of progress. Of course, we're still working on our ForecastTrader. Will the Fed lower by 25 basis points in March? That's currently at yes, 15%, and no, and 86%. Expecting really the first, we're going to go live to our ForecastTrader tool now before we wrap up, but really expecting the first rate cut to come around June or so.
And as you're looking at the ForecastTrader, Jose, are there any aberrations at this point? Is there anything within the consensus view amongst investors that you would say is just wrong, and this is how you measure it in the ForecastTrader?
Generally speaking, there's tons of opportunities. Nothing really comes to mind at the moment. There's daily opportunities when you consider how the prediction market world is still learning how to price out economic events. So that, for example, for non-farm payrolls, I told everyone in the daily article that, by the way, folks, if you don't know, there's a daily article where in most cases, 75%, 80% of the cases, I'm offering my opinion on which contracts are undervalued. Those trades have a really strong record of success. If you go back, everything is public. You can see all of them. If you go back and you check, just because I used to work at the statistical agencies and I've been around for a while, so I have a good grip on what the percentages should be. So, for example, for non-farm payrolls, there was a 10% chance or so that a number wouldn't exceed negative 50,000. So we'd have a significant loss in January's report. I thought that that was way undervalued. That should have been closer to like 3 or 4%. So that 10%, 90% no would have been a good investment, in my opinion. So that's, that's sort of the things that I think about. I think right now the House race for the Democrats is around 76%. I think that should be a little higher. I think that should be closer to 85. Usually the incumbent party that just won the White House, so in this case the Republicans, tend to lose in the midterms or lose some control in the midterms. And there's a lot of seats out there that are really up, that are toss-ups. The Democrats are poised to take. So I think that that's an undervalued contract, albeit it is in the political realm, not necessarily in the economic realm. As far as what's been the most popular, it's really been the temperature contracts, the daily temperatures, and which is, a climate environmental kind of contract, but that's been getting a lot of enthusiasm every day. So essentially questions like, what will the hottest temperature in Phoenix, New York City, Miami, San Francisco be today, February 12th? Right. So we will first we'll go to the Fed decision contracts to see what we think about the first cut. And then we'll go to some temperature contracts. And I think I'll answer some other questions, and I think we can get close to wrapping up unless the crowd has something to say.
If you've got questions for Jose, please do put them in the chat directed through LinkedIn and X platforms at IBKR, please. I was going to ask you something there, Jose. Can you talk a little bit about the Fed governor race and how that played out? I think that's a really good example historically of how you can use these markets.
Yeah, I mean, for a while we thought that Warsh, we thought Hassett was the favorite for a while, and then Warsh came out and essentially secured the nomination. Traditionally, more of a hawk, more of a higher real rate kind of person, more of a lighter balance sheet kind of individual, but recently has publicly opined that rates should be lower and that the Fed should pursue a more accommodative stance. Of course, that's what the president wants to hear. So that, in essence, secured the nomination. There's also been talk that back in 2018, 2017, Warsh was second in the running behind Chair Powell, current Chair Powell, and President Trump, of course, would have preferred to pick Warsh instead of Powell because he references, at the time, Treasury Secretary Mnuchin as really pushing for Powell and Trump listening to him, but then regretting it. So now we'll see what happens. I do still think, Andrew, that Warsh carries the highest probability of amongst the participants, amongst the nominees. So when you consider Hassett, Waller, I think Warsh has the highest probability of standing up to the president if he thinks that rates shouldn't go down, if he wants to keep steady or hike. But we'll see how that goes. Our colleague Steve Sosnick has had some really interesting commentaries lately talking about how usually the first year of a new Fed chair's term, markets start to test them A little bit of volatility back in when Chair Powell was in 2018. We had a down year in the market. Chief strategist Sosnick's price target is essentially for a light down year, flat year, whatever you want to call it, price target around 6,500 to digest the spectacular gains of the last few years and to account for the market taking some of that back. So we'll see what happens. It's going to be interesting, that's for sure, especially against the backdrop of you have the White House wanting to run the economy hot with deficits, with stimulative policies. So I think the economy keeps growing. I think earnings are going to do great, but there could be some volatility hiccups on the road to the other side.
And I think Andrea has posted into the various channels for LinkedIn and X a link to your ForecastTrader commentary, which comes out most days of the week. So please look out for that in the chat there. So what are we showing here? The highest temperature in Miami. Will it exceed 7 to 9 degrees today, February the 12th, 2026? And I can't see the numbers there, Jose.
Oh yeah, the number 79 degrees would be 65 cents on the yes. Let me try zooming in here, and 33 cents on the no. And really, folks, we've been adding a lot more cities now. Andrew, this is brand new. This is an initiative from this Tuesday, so I think this may come to your surprise as well. But we have a lot of other cities. Yeah, we have now Minneapolis, St. Paul. We have Atlanta. So we have some other cities. In the past, we had only 10. Now I think we're up to 24. Europe
coming
is not
soon
online.
to a city near you.
Yeah, Madrid is not online yet, but as you can see, we're working. Philly. Shout out to Jeff Preisman. And shout out to Andrea, by the way, who's in the back there, always helping us out and with the tech. So really, thank you for your efforts as always. So yeah, so
making this work seamlessly.
Yeah, making it work seamlessly. Absolutely.
All right, Jose, I think there's no additional questions from the audience, so I think this will be an appropriate time to wrap up. Thank you for your time today. Good luck with your speech engagement at the IMN conference in Scottsdale, Arizona. And if there's anybody in the area, pop along and see it. Where is the event taking place, Jose?
The event is taking place at the Scottsdale Resort and Spa. It's a Hilton property. Yeah, so absolutely. My talk is at around noon. It's the keynote, 12:35 to 1:05, 30 minutes. So if you want to hear a lot of what was said just now again in person live, come on down.
Brilliant. Jose, thank you very much for joining us today, and good luck later on.